Hey folks, welcome back to Wash Capital and to this week's Market Analysis Explainer. This detail covers the week of June 8th to June 14th, 2026. This week's market story had two threads, one geopolitical and oil driven, one structural, about the largest IPO in history and the market plumbing operating beneath it. Here's the roadmap. We'll start with oil, CPI and rates, because the Iran deal is rewriting the forward inflation picture in real time. Then we'll go under the hood of the SpaceX IPO, the valuation, the float, and why the index inclusion mechanics matter more than the headline number. After that, portfolio validation. No changes this week, and the data explains why. And we'll close on the distribution. We're in a transitional regime. Tail compression is real, but confirmation's still pending. Let's get into it. The dominant driver this week wasn't a data print, it was geopolitics. The US-Iran deal that's been close for weeks now looks genuinely like it might come to pass, with US officials reportedly putting the odds at 80% within days. The number I want you to hold on to is the OMOIL Brent spread. This week, it printed at a $4.83 Brent premium, the most constructive reading in this framework's history. OMOIL, the physical Oman benchmark, fell more than twice as fast as Brent in percentage terms. Tanker operators taking actual delivery through the Strait of Hormuz are pricing a meaningfully lower corridor risk premium than the paper market is. The physical market isn't waiting for a signature. It's already pricing the deal. That oil move explains the CPI story. May's headline print came in at 4.2%, above the 4% trigger I flagged in Report 26, but core came in at 2.9%, slightly below the monthly forecast. Energy did almost all of the damage to the headline figure, and energy is precisely the input that's just fallen off a cliff. The bond market's read wasn't ignore the inflation print. It was, this print is measuring a world that no longer exists. A backward-looking energy spike is a poor guide to the forward inflation path when oil's already fallen. That's why a 4.2% headline didn't push yields higher. Markets don't price for tomorrow's risk based on today's events. They price weeks and months ahead. This week's data shifted those priors. The front end led the rally this week, mirroring last week's front end led sell-off, just running in reverse. The 2-year fell 1.40% to 4.087%. The 10-year fell 1.08% to 4.483%, with the 2-year at 4.087% against a Fed funds ceiling of 3.75%. The behind-the-curve premium narrows to roughly 34 basis points, down from around 40 last week. Still positive. Still a market that doesn't expect cuts, but the edge of that view's softened slightly. Volatility followed the same script. The VIX fell 17.81% to 17.67%. Back below the 20 risk regime threshold it crossed last week. The move fell 7.77% to 69.36, both falling together as the inverse of last week's systemic configuration. That's meaningful de-escalation, not just a single index retracement, but it sets up Kevin Warsh's first FOMC meeting on June 16th and 17th as the next live variable. It holds the overwhelming base case. The market's pricing that at roughly 97%. The live question is whether the Fed explicitly drops its easing bias. That's a communications event as much as a rate decision. Wash's first dot plot and press conference are going to be parsed for tone more than for the number itself. The other story this week wore a $1.75 trillion price tag and a Nasdaq ticker. SpaceX's IPO was by some distance the largest in history, and it's a useful case study in the kind of structural thinking this report tries to encourage. What you're being offered, who's setting the terms, and why the mechanics matter more than the headline. Start with the valuation. At $1.75 trillion against roughly $18.5 billion at 2025 revenue, SpaceX priced at approximately 94 times trailing revenue. Nvidia sits at around 20 times. Palantir, one of the next highest, sits between 60 and 80. A 94 times multiple assumes years of flawless execution across multiple business lines simultaneously. There's virtually no room for anything to go less than perfectly. Underneath that headline, the segment structure matters. Starlink is the profitable core, around $10.6 billion of 2025 revenue, 2/3 of the company total, with adjusted EBITDA around $6.6 billion. The other two segments, the launch and Starship development business and the recently integrated XAI unit, are currently loss-making. The company posted a GAAP net loss of close to $5 billion for 2025, with a further roughly $4.3 billion in Q1 2026 alone. You're not just buying the profitable satellite business at a premium, you're buying two loss-making, capital-intensive bets alongside it, priced as if they're already worth something close to what Starlink is worth today. Then there's the float. SpaceX is reportedly offering fewer than 5% of its shares in this IPO. That's an unusually small slice relative to the headline size of the deal, and it tells you something about where control and the bulk of the economic upside continues to sit. Price discovery on a thin float can be considerably more volatile in both directions than the valuation figure alone suggests. The index story is where the incentives become most visible. Nasdaq and FTSE Russell both rewrote their inclusion rules to accommodate SpaceX. Nasdaq specifically removed its 10% minimum float requirement in May 2026, a change introduced for this listing. The S&P 500, by contrast, declined to change its rules. SpaceX fails the S&P's standard criteria on at least 3 counts. It hasn't traded publicly for 12 months. It hasn't posted 4 consecutive quarters of GAAP profitability, and its float falls well short of the 10% minimum. So it's excluded from the S&P for at least a year. The practical effect, passive funds tracking the indices that did adapt are now structurally required to buy SPCX, regardless of valuation, multiple, or the loss-making segments, simply because the index composition rules say so. Index membership's a mechanical, rules-based event. It's not a verdict on value. And the rules themselves, it turns out, are negotiable when the listing's large enough. Which brings us to Charlie Munger's line. IPO stands for it's probably overpriced. His point wasn't that IPO businesses are bad. It was about asymmetric information and timing. The seller chooses the moment, and that moment is chosen to maximize their outcome, not the buyers. No changes this week. And this week's data validated both of the signal-driven exits from the last month without requiring any new analysis. Gold fell a further 2.55% to $4,213. Continuing the move that began the week, the Valkyrie position was closed at $4,543. The decline this week wasn't rate-driven. Falling yields are usually supportive for a non-yielding asset. The more likely driver is safe haven demand unwinding alongside the broader Iran de-escalation. The exit continues to look well-timed. Bitcoin's 1.17% recovery is a liquidity-conditional bounce, consistent with the broader risk on tape this week, falling rates, falling vol, and not a structural reversal signal. The 4-year cycle framework from Report 26 is unchanged. The historical trough remains positioned for October to November 2026. The zero allocation stays in place until the signal says otherwise. That signal hasn't moved. The equity sleeve, 38% US, 16% developed ex-US, 6% emerging markets, captured the broad rally across all 3 legs. The Russell was up 4.69%, driven by the rate relief we covered. EM reversed its entire prior week decline. Nothing approached the rebalancing threshold. The 40% cash positions unchanged. That's optionality held against 2 confirmation events next week, not a forecast. The model responds mechanically when things cross a threshold, not in anticipation of them. The distribution shifted meaningfully back toward the centre this week. The bear tail compressed from 28% to 18%, VIX back below 20, move falling in tandem, and the OMOIL spread at its most constructive reading yet. The base scenario moved up to 54%, the bull tail expanded to 28%, the skew improved to minus 0.15 from minus 0.45 in Report 26, the least negative reading since the conflict period began. The risk barometer moves to moderate risk, the first improvement in several weeks. One category moved to tailwind, volatility. Geopolitics and growth remain slight tailwinds. Policy and inflation remain headwinds, both penned in next week's confirmation events. My framing for this week is compression, not resolution. The Iran deal is reportedly close. It's not signed. The FOMC is expected to hold. It hasn't happened yet. The CPI print that looked hot was explainable, but explainable and resolved aren't the same word. Distributional thinking means holding both of these at once. The week's data genuinely improved the picture, and the picture still depends on 2 events that haven't happened yet. That ability to hold 2 ideas simultaneously is what separates Bayesian thinking from absolutism. It's one of the things this series tries to build. The Valkyrie model made no changes and didn't need to. Both zero-allocation calls from prior weeks continued to validate themselves mechanically. The 40% cash position's exactly what it was designed to be, optionality, held against a week with 2 genuine confirmation events on the calendar. As always, the full report's linked below, and you can read or listen on Substack. If you appreciate these updates, please like, subscribe and share. It really helps get the content noticed. Until next week, stay safe out there. Was.